NUA, Net Unrealized Appreciation. This is something you should consider if you have significant gains in your stock that you have contributed for many years to, and you're wondering, okay, what's the best thing for my situation? Should I potentially use this NUA? Should I do tax gain harvesting? Is there another thing? What the heck did you just call me? I focus on early retirement planning, and in this video, I'm going to walk you through a real case of a client who we decided should use NUA. You might watch this and go, wow, that's very close to my situation. I should use this. Or you might learn it just doesn't make sense for you. So either way, I hope it is helpful. We're going to start hopping in. I'm going to start by explaining NUA, but I'm a visual learner, so I'm going to show you an example on my screen in just a second. So what the heck is NUA? Well, most people assume when you take money out of a 401k, you have to pay what's called ordinary income taxes, which basically just means you made more money. So that's that federal tax bracket system that we talk about here in the US. So you can see here on my screen, if you are married filing jointly, the first $23,850 that you make gets taxed at 10%. The remaining $23,851 to $96,950, 12%, and so on. So that's true. That's what happens when you take your money out of a 401k. You got a deduction, it grows, you don't pay any taxes. It's called tax deferred. Then when you take money out, you do have to pay taxes. But if you have significant company stock, you have the option to do what's called NUA. Put simply, you can move your company stock from your 401k into a brokerage account, which I call a superhero account. Now, why the heck would anyone want to do this? Well, if we look at these numbers here, these are those federal tax brackets. So not state, just federal. 10, 12, 22, 24, 32, 35. I'm going to guess if you're even thinking about NUA, you have a pretty significant amount of stock in your 401k, meaning you have a cost basis, what you put your money essentially in for, and then you have market value, which is what it's worth today. And if there's a big difference there, you want to consider what I'm talking about. Because why is this advantageous to not do this and maybe do NUA? Well, capital gains rates, you can see, guys, those are way lower, 0, 15, and 20. And you can see most of you are in the 0 and 15 category, which sounds way better to me than paying 22, 24, 32, etc. So the cool thing is you only, if you use NUA, pay ordinary income tax on the cost basis, not the entire thing. If you were, hypothetically, and I don't recommend many of you do this, if you were, for example, to take $3 million of Microsoft, I don't know why I said soft, but Microsoft stock out of a 401k, once again, you're paying ordinary income taxes. If you're in California like me, you're in that 50% bracket on some of those dollars, which I imagine you don't want to do. I'm all about being patriotic, just not to the point you pay more in taxes than necessary. So the way to think about it is your cost basis, that gets taxed at ordinary income. But any of the growth, that could be taxed at capital gains. So let's look at an example. So you can see here, guys, this is not pretty. Okay, so you guys can make fun of me all you would like. This is not pretty. This is just a real client. Some of you are going to go, well, is there a specific spreadsheet for this? No, I just put this together quickly to explain to my client when it makes sense and when it does not make sense to do. So you can see here, this is their ordinary income. Okay, so this $330,000 is their cost basis. They have capital gains of $122,961 because this is what their stock is worth, $453,000. So what you paid, meaning $330, your cost basis, ordinary income. Anything beyond that, taxable at long-term capital gains. The remainder is taxed based off of when you sell. It depends. So it's cool. You get tax preferential treatment. So that's why we would want to do this. You don't have RMDs nearly to the same degree. Why? We just moved a ton of money into a brokerage account. No RMDs on brokerage accounts. But it's not the same as just leaving non-NUA shares. And a lot of people get that wrong. So what happens is your 401k balance, that goes to an IRA, Roth IRA, except in this case, Microsoft, which could go to a brokerage account. You pay taxes on that distribution, so $330 this here, but the gain is taxed at long-term capital gains. Now in this example, my client had 401k fund fees of $7,200 a year, and they were wondering what would the cost be to change. So you can see they'd have a $4,000 difference in savings by doing this. This was another example that we are going through just so they could fully understand this. I'm going to skip over this for the topic of today, just in light of time here, but here's the basic example that I think is going to help you. So what you can see here in this just really simple example is in your 401k, you might not have all company stock. There might be some. So let's pretend you have $1 million when you go to your 401k, but $600,000 is in traditional investments. Let's call it a target date fund, and $400,000 is company stock. And of that, $200,000 is your cost basis. That means your NUA is this number right here. It's the 400 minus the 200. So if we go back up to a real example, if we have 1.7 million, which is what my client had, 1.2 was in a traditional investment. So mutual funds, ETFs, things like that. 453,000 of Microsoft was what their company stock was worth, and 330 was their cost basis, which means they have NUA of 122,000. NUA is their tax savings. Stick with me here. I'm almost done, I promise. So their current tax rate, meaning my client, was 35%. They're making a healthy income. At retirement, they're going to be in a lower tax bracket, 22%. So would we want to go pay taxes at 35 if in the future we're going to pay tax at 22? No. Wouldn't you rather pay at 22? Yes, we would. So RMDs in the future for my client, meaning their tax bomb, they would be paying tax at 33%. So the more NUA, the more tax savings. So in this example, some things that they wanted to consider for NUAs is you must take the lump sum of the whole 401k to do. You can't be like, I just want to take some of it. In the year that you take the distribution, the taxable amount, that cost basis, that's taxable. And then this is something a lot of people forget. So I had one client go, well, I'm going to move all my money to a brokerage account. And then if I pass away and I'm not in good health, then my heirs, they're going to inherit it and pay no taxes. It's like a genius move. My kids, like, they're going to be doctors and they're going to make tons of money. But the NUA doesn't get the step up. So that is taxable to heirs as ordinary income. So this was the way I just simplified it for them. You can make fun of me once again, guys. I know it's not pretty. This is just how I do things. Sometimes I'll use the spreadsheet. That's really powerful that I talk about all the time. This is where I'll go through their investments and we talk about their 401k and Roth, and we go over fancy probability of success, and I'll use all the tax strategies. If you guys want to use all this and get super fancy with this, like, be my guest, okay? I love getting to do this too. But sometimes I just want to use a spreadsheet because I like Excel. So in this example, we just wanted to look at the math. It's not what I think, it's just math, which is why I love this stuff, because if you're smart with this, you can retire earlier, save on taxes, and you get more time with family and friends. So with NUA, you can see here, if they're paying a long-term capital gains bracket of 15%, once again, where am I getting that? That 15%, that's just federal. So if they're paying 15% taxes here, you can see based off they're married, finally, jointly, or single. Don't forget about the standard deduction. Also, don't forget about state taxes. Also, don't forget about net investment income tax. But just to keep it simple here, 15%, meaning their total tax bill, what they're going to have to pay today, reminder, let's go over here, this 122, those are capital gains. That is their gain. So they're going to be paying, you can see here, $18,444. That's this. What if they do not do NUA? Okay. If they don't do NUA, which is an option, by the way, some people just assume you should do it. It's not that simple. 22%, that's their retirement tax bracket. So leave everything in your 401k and just pay 22% taxes on it. Well, it's probably going to be 22% and increasing because 401ks rise, and you're going to have RMDs and other things. But you could see you're looking at a $99,000 tax bill. So when should you do NUA? This is kind of me showing an example of, okay, when could it make sense? Well, it depends on how significant is the gain. How much winnings do you have? Because that's what it comes down to. So without NUA, you can see total tax, $99,000. With NUA, total tax, $133,000. So tax savings without, 34. That difference here. So why is this so interesting? Well, because some people are like, oh my gosh, I got to do this NUA thing no matter what. Look, it depends on how big the gains are, because we're going to have to go, and this is what people forget with this stuff, which I don't blame you, by the way. There's a lot. You're going to have to go pay taxes on this cost basis, this is your ordinary income. Okay, that's significant. So you have capital gains that you're going to have to pay, $122,000 on. Those are the gains if you were to sell right away. Now, this is the value, but once again, look at, you have a big, in this example, cost basis, $330,000. Remember, that is taxed at your current tax rate, okay? So that is significant. That's not a small amount of money. But imagine you had, for example, a company stock that was worth $1 million. Well, the NUA is more attractive. More NUA, more tax savings. So in this example, if they don't do any NUA, you can see their total tax, it's still significant. It's not a perfect example, okay? And to them, I was just explaining it simply to say, look, what if it's 22%? The reality is, if we go back to the sheet here, Are they going to be in this exact tax bracket for their whole retirement, 96,000 to 206? No, it's probably 22 and then 24 and potentially 32. So in this example, I was just showing them, hey, simple math, if 22% was your retirement bracket. But here we have to pay capital gains, which that's not a big deal. Those are the gains. The main issue is, once again, we have to go ahead and go, ooh, 35% our current tax bracket of this. That 115,000, that does not sound fun. So if we are taking that 115,000 and we're adding 18,444, you can see here we get an error because I think I need to put a dollar sign here. Nope. What am I doing wrong here? Some of you are like, okay, Excel expert over here. What the heck's going on here? Okay, so you can see this is, I even got it off by a few dollars. But the idea here is NUA can make sense and it cannot make sense. So you can see I was explaining, what if you had a big gain here and your current tax bracket was different? That's when NUA could make more sense. So I know this was kind of not my smoothest video. I recognize that because I'm just using my spreadsheet here. But if you are able to literally screenshot, copy my logic here, you're going to be able to understand if NUA makes sense for you. And if you want to connect the dots, because this is what we really focus on, if you're going to your tax tab, your tax strategy in the software, you want to make sure you're able to elect or model or reflect in some way if NUA is being used for your plan, which is something that we obviously help our clients with. So tax strategy, estate planning, withdrawal, healthcare. We love getting to do all this stuff. If today's video resonated, please like it. Please comment below what you learned from it, and please share it with someone else who you think might be in a similar situation. Maybe it's a coworker, maybe it's Microsoft stock, maybe it's Nvidia, maybe it's Apple. We love getting to do what we do here. And if you go to our website, rootfinancial.com, in the upper right, you'll see a little button that says see if you're a fit. You can click that to answer a few questions, and we might be talking very soon. Thanks, guys.